What's happening, everybody? It's your boy Kreative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all today. We're going to be breaking down puts. What does it mean to be a put trader? What does it mean to be bearish on the market, right? And to being able to submit a trade live with y'all with our put bot that we've created. Now, if you haven't already, I need you to go ahead and smash that like and subscribe button. And I'm going to be breaking this down in lessons, right? And after each lesson, there's going to be a check for understanding quiz just to be able to make sure that y'all are following me. So I need you to go ahead and drop it in the comments what you think the answer is as we go through this. So let's go ahead and jump in. So block one is going to be talking about the right, and the right is going to be to sell, right? So what is a put contract exactly? So a put contract is a contract that gives us the what? It gives us the right, but not the obligation to sell 100 shares. Now, why is it 100 shares? For every option contract, there is 100 shares within one option contract. So please keep that in mind. And we can be able to exercise it at a specific price, right? That specific price is going to be our strike price, and we need to do that before a specific date. That specific date is going to be our expiration date. More on these two terms in a bit. Now, in order to get into a put contract, we need to be able to pay the premium, and the premium gives us the right, but not the obligation to sell 100 shares of this underlying option contract. But now, why would anyone want to buy a put contract? Because we think that the market or the underlying stock will go down, right? We're bearish on the market, right? What do bears have? Bears have palms. What do those palms do? Those palms are normally on the ground, right? So you bear down, right? When you're bearish on the market. So you believe SPY will drop. We buy a put contract to profit from the decline. Scenario two is portfolio protection. You own SPY and you fear a crash. So we buy puts as insurance. If SPY crashes, your put gains to offset the stock losses. So think of it like car insurance. We pay a premium hoping we never need it, but when we do need it, it does protect us. So being able just to take a peek at the market real quick, and I'm looking at the S&P 500 on the 1-minute chart, and what we're looking at is seeing I'm going to say a put setup probably, but the bulls just took back over. And whenever you see a red candle, that is going to be the bears. Whenever you see a green candle, that is going to be the bulls. And each one represents 1 minute of action between the two, right? So right now we're seeing the bulls just take back into the market. And if you're watching this, this is March the 6th, 12:53 p.m. Eastern, and what I'm looking at this. So it's a nice live look in to be able to see what the market is actually doing. So more on this in a bit. So the put option payoff at expiration. So this is going to be our stock price, right? So we think that the market is going to go down. So our max loss is going to be just above or just below, excuse me, the premium that we pay, right? So let's say, for example, we paid $100 for this put contract. So we'll put my max loss at maybe $90 or $85. So our stop loss is going to be 10 or 15%. So let's put it at $85. So our stop loss is 15%. I'm going to be making a video on stop loss because I think that is something we need to be able to really hone in on and understand. Because it took me a while to really understand stop loss, the difference between a stop loss at the bid or a stop loss at the axe. And again, that video that I'm going to be dropping soon is going to be going into that. So when we make money for on a put bet is when the stock price goes down, right? So we profit when the stock we can profit when it goes to zero. So the max profit is going to be the strike minus the premium, and if the stock goes to zero, right? So live look, we have SPY 673 put. Our premium that we're going to be paying for this option contract is $145 per share, or per contract is going to be $145. Why? Because for every option contract, there's 100 shares. So this gives us the right to sell SPY at 673. Even if SPY crashes to 500, 400, or even lower, we still have that obligation from this option contract, right? This put option contract. So our break even is going to be SPY must fall below this in order for us to profit. 671.55. Our max loss is going to be the premium paid, and our max gain if SPY goes to 0, but super unlikely. But if it does go to 0, we just profited 67,000 from a $145 bet, right? So we understand that. So a put gives us the right, but not the obligation to sell SPY or an underlying option contract because we are bearish on the market. So a put, and I just look at that, just gave you the answer. But a put gives us the right to do what? To sell a stock at a strike price. You buy a put because you think that the stock will do what? Go up, sideways. Interesting, but maybe that could be. I wouldn't be mad if you said sideways in a little ranging market. You could buy a put and being able to profit off that real quick. So I wouldn't be mad at that. But in essence, the real reason you're buying a put is because we think that the stock is going to go down. All right, so your max loss for buying a put is going to be unlimited. Not really, but it's depending on the type of put that you do. Like if you're shorting, then yes, it is going to be unlimited, but we're just talking about long puts here, right? We're not going to be shorting or anything like that. So it's going to be what? The premium paid. All right, so let's go ahead and go to block 2. Block 2 is going to be talking about the strike price. This is going to be the price where you can sell. So the strike price is where you have the right to sell the stock for a put. ITM is going to be a strike price above the current price. This is puts now. Now calls were a little bit different, but for puts, need us to be able to understand how it works for puts. All right, so for puts, ITM is above the current price. ATM is equal or near the current price, and then OTM is below the current price, right? So ITM above the current price, ATM at or near the current price, and then OTM is below the current price. So moneyness, ITM puts are going to be strike prices above it. So the strike price is at 550. And strike is not at 550, it's at 673.79. But hey, this is just for the purpose of a illustration, so it can be easier. So strike is at 550. At or near is going to be our ATM. And then anything above it for puts is going to be our ITM. This is the most expensive. These already have value because of the intrinsic value that is built into the ITM contracts, but more on that in a bit. And then we're going to have our OTM. These are going to be our contracts that are below the stock price. Cheaper, but we need a huge gain in order to profit. So here's a live look at it. And the reason we have ask is because whenever you want to get into the market, you're going to be paying the ask price, right? Like, for example, let's not even go to the analogy, but you want to get into the market, you want to be paying the ask price. When you want to get out the market, you want to be paying the bid price. And then here's deltas. Now, another thing to be able to keep in mind is for put contracts, you're going to see it negative. Right now, don't let that alarm you, right? It works the same way with regards to the probability of profit. So here we have a 44% chance of this being able to expire at or near the money, right? Or it's going to let us know how much money are we going to make per stock move, right? So here we're going to have ATM and then ITM is below, right? So let's just go over this one more time. When we have a put contract, it's going to be the strike price that is above it for ITM. ATM is at or near the price, or OTM is below the current price. All right, beautiful. Let's jump into our quiz. So if SPY is 673.32, the current price, what put is in the money, right? So ITM is above, ATM at or near, OTM is below. So ITM is above, right? So it's not going to be this one. This is going to be OTM because that's below. This one's going to be ATM because this is at or near. And this is ITM. This is above. So this is going to be C. What put typically is cheaper? Is it ITM and the money? No, because these are the most expensive, because this has intrinsic value. More on this in a bit. ATM, I mean, it depends. Like some OTM and ATM could be damn near priced the same, but for the purposes of being able to go through our example, it is going to be our OTM that is below. So put moneyness is blank of call moneyness. The same? The opposite, probably, or unrelated. So it is going to be the opposite, fam. Remember we talked about it for calls in the previous video is below, but for puts it's above. So it's a mirror image of each other. So now let's go to the expiration. The expiration is the time enemy for put buyers. So every put has an expiration date. After expiration date, ITM puts are exercised. You sell the stock at the strike price. OTM puts become worthless, right? You lose the premium that you paid. And then time decay or theta works against us for put buyers. So every day your put loses a little value. Decay accelerates as expiration approaches. So you may want to remember that. You need the stock to drop fast enough in order to overcome theta. So expiration types, we have 0 DTE. These are option contracts that expire the same day. These are a little bit more risky, so higher risk reward ratio, need a quick move here, right? Then we have weeklies, anywhere between 1 and 5 days. And then we have monthlies, anywhere between 15 and 45 days. And then we have leaps that are 6+ months. So a visualization of our time decay based off of the expiration, as you can see for 60s for leaps, right? 60 days to expiration. These will really be monthlies, but leaps, monthlies, I think they fall in the same, but let's go 2 months, monthlies, right? As you can see, the value decays as we get closer to expiration. So 0 DTE, damn near have no value, right? But as you get further away from expiration, the value definitely does increase. So a live look at it. So 0 DTE, these are option contracts that expire the same day. And then we have our weeklies and then our monthlies set up here. So now let's go jump into our quiz. What happens to OTM puts at expiration? We just talked about that, fam. Oh, look at that. The bulls are definitely rallying, bruv. They're definitely rallying. Remember we started, it was here. Now they're going to oversold prices, right? This is the Bollinger Band. So this top line is going to be the oversold. This middle line is going to be the 20-minute average. So the simple moving average. And then this bottom line is going to be the overbought, oversold, simple moving average, right? So right now what's happening is that the bears are trying to take control of the market, but you see this wick that just proved here, and we're from a body to a wick. The bears just took back over, but the bulls are trying to push the market, but there's a little bit of indecision that's coming, and the reason that's indecision is because we have a wick, right? And this wick is damn near turning to a hammer, right? So that's interesting. So let's see how well this is going to go while we keep going. There's more of a body is coming. So I say that to say is that what happens to 0 DTE put contracts at expiration, that becomes worthless. And I need y'all to follow along with me, right? So if you know the answer, go ahead and drop it into the comments and let's have a discussion about it. So time decay, theta for put buyers is blank as expiration approaches, right? It is faster as expiration approaches. So which put has the most time decay per day? Is it 0 DTE, option contracts that expire the same day? Is it monthlies or is it leaps? So which put has the most time decay per day? This is an interesting one. I'm going to say, I think it's 0 DTE, but I mean that per day thing kind of throws you out because 0 DTE, you're losing money per minute, right? Let's go with leaps. Why did I second guess myself? I knew it was 0 DTE. All right. That's all right. That's all right. No, I'm vulnerable. I'm human. I'm only human. All right, I'm sorry. Let's talk about premium, fam. Premium is broken into intrinsic and extrinsic value. The intrinsic is going to be the real stuff that's baked into it, right? So for puts, it's going to be the strike minus the stock price. And then for calls, it was just the opposite. But for here, it is the strike minus the stock price if it is positive. Only ITM options have intrinsic value, right? Example, a put at 560 put when the stock is at 550, the intrinsic is $10, right? Because it is above the stock price. And then extrinsic is time value, what you pay for the possibility of profit. This is affected by time of expiration, volatility, and the distance from the strike. So this is what decays over time, right? And this is our theta. So here's a live example of a premium calculation. We have the stock price, we have the strike price. So this is going to be ITM because it is above, and the premium paid is $1,400, right? So the how much of that is intrinsic? So the intrinsic is going to be the strike price, so 560 minus the stock price, that's going to be $10. And how much of that is extrinsic is going to be 14, the premium paid, minus the intrinsic, and it's $4. So of the $14, 10 of it is intrinsic and $4 is extrinsic. The extrinsic is the time value, and this decays to 0 as expiration when you're marching towards expiration. So the stock price of 550, let's go through another example, and then the strike price of 540, and then premium paid was 3. So intrinsic, this is OTM, right? So OTM already told me what it is. Remember, OTM has no intrinsic value, right? So this is all no real value yet. And then extrinsic, it is all extrinsic, is going to be the premium paid. If the stock doesn't drop below 540, the entire $3 or $300 is lost at expiration. So here's a live look at our option contracts. So just based off this, how much of this is OTM contracts, right? So just looking at this, these first two, I'm going to say is OTM, right? Remember, for puts, OTM is what? Below that thing, right? And no intrinsic value. And then at or near, and then above ITM right here. All right, so let's jump into our quiz. So a 683 put, this is our strike price, cost $15. So that's our premium with a stock price of 673. What is the intrinsic value, right? So we're going to do, I wish I had, you know what? I should have had my little whiteboard here so we can do this real quick. So here's the whiteboard. Give me 2 shakes of a second. Let me just make it a bit bigger. Yeah, bruv. So let's take our question. Let's go to our whiteboard. I know Siri. Thank you. Don't do that. Beautiful. Alrighty then. Beautiful. So strike equals 683. Premium equals 15. And then stock price equals 673, right? Now, in order to figure out what is the intrinsic value, remember, we're going to take our strike. Oh, let me come here. Strike minus the stock equals intrinsic. So strike 683 minus the stock 673, right? So we have 10. And then the extrinsic is going to be the premium minus intrinsic equals extrinsic. So the premium is 15 minus the intrinsic of 10. So then we have 5. Bet. So we have our work. All right, so let's come back to, we have our answer. We just did our work. Beautiful. It is going to be B, bruv. Good work. An OTM put premium is made up of 100% intrinsic value. Not so much. 50 intrinsic, 50 extrinsic. That doesn't sound too right. That can be, just depending if it like shoots up in value. Or is it going to be 100% extrinsic value? We've heard that before. What happens to the extrinsic value at expiration? It doubles. I wish. It goes to 0. That's probably right. Or it converts to extrinsic. I won't be mad if you said that either. All right, so let's talk about the Greeks and how it works for put option contracts. So for delta, this is our direction and our speed. For puts, it's always going to be negative between -1 and 0. So a delta of -0.5 means that the put gains 0.50 when the stock price moves $1. So more negative equals more sensitivity to drops. So delta also equals the probability of expiring in the money, right? So another way of saying this, for every $1 move, this option contract is going to gain $50. And it's also a 50% chance that this option contract is going to expire in the money. Gamma is going to be our rates of change, is how fast delta changes. So highest for ATM near expiration and can make your delta move rapidly. So if gamma is the car, delta is the pedal. Theta is going to be our time decay. We talked about this. For put buyers, it's always negative. It's working against us. So theta of -0.5 means that we're losing $5 a day. Accelerates as we approaches expiration. And then vega is going to be the volatility sensitivity, how much the put gains when volatility increases. With vega of 0.10, it means that the put gains $10 for every 1% increase in IV. So puts benefit from volatility spikes. And what is volatility? Fear equals high IV. So a visual of how this works. So we have a put that is -1. This is super deep in the money, highest sensitivity, almost a 1-for-1 move with the stock. Then we have ITM, strong move with the stock. Then we have ATM, 50% odds for being able to expire in the money. And then we have OTM, lower sensitivity. And then we have deep OTM, very low odds of being able to expire in the money. Puts delta are negative. So a -0.50 delta means you gain $50 per share when the stock drops $1. So that's why it's negative. So here's a live look at it for the put Greeks when SPY is at 674.36. And we can see just based off of this, we have a few, mostly, here's our ITM right here. Remember, ITM is above, ATM at or near, right? And then we have one OTM right here. You can also tell by the delta as well. So a put with a delta of -0.4 will approximately gain blank if the stock drops $1. It is going to gain $40, 0.40. So that's going to be A, fam. Beautiful. Which Greeks works against puts buyers every day? We've been talking about this all day, right? And it is going to be theta. So when VIX spikes, fear increases. Put premiums typically do what? Stay the same. Decrease? I don't think so. Stay the same? Probably not. Or does it increase? All right, beautiful. And here is our trade, right? So let's walk through how to be able to compose a trade, right? So we're going to identify a thesis. So are we bearish on put? Are we bearish on SPY? If we're bearish on SPY, the current price of 675.63, we expect SPY to drop, and the time frame is going to be today, right? So this lets us know a few things. We expect SPY to drop, so we're going to be buying a put contract, and we're going to be buying a 0 DTE contract, right? So what we're going to do is we're going to select the contract of 676 put. And is this going to be ATM, ITM, or OTM, right? Remember, it is going to be ITM because ITM, ATM. So I won't be mad if you say ATM as well, because it is above the current price, right? So because it's above the current price, this is going to be a little bit more expensive. So we're going to be paying our axe price, and this is the price we're going to be paying to get into the contract, right? The delta is 77. So it's letting us know for every $1 drop, we're going to be making $77. So that's not bad, but we're losing theta's kind of high here too. So how to calculate your risk? So we're going to be paying $356 per contract. Our break even is going to be 672.44. SPY must fall below this in order for us to profit. Our max loss is going to be our premium paid, and then our max profit if SPY goes to zero, theoretically, but if SPY goes to zero, is 67,000. So here's a few scenarios. SPY drops 2%. Our put value contract now is 1388. All right, we just made $1,000 just from that 2% drop. If SPY drops 1%, we just made 100% just based off that. But if SPY stays at 673 or even go higher, we just lost the premium paid. And then our take profit is going to be our 50% or 100%. That's kind of a little greedy. I'm not going to admit it. And I'm going to talk about this a little bit more once we go to our put bot. Stop loss is going to be, okay, I don't want to lose all the money, right? But I do want to be able to give it some room to grow. So 30% is extremely high. 50%, I will just be looking at you crazy, right? Never let the position go to zero. And then our time stop is going to be what we want the position to stop at. So let's go ahead and jump into our put bot that we've created. And this is going to actually model the market to see if we can take advantage of this bit of a bearish drop that we see here, right? So remember, when we first started, it was here. Now it's made its way to oversold territory. Excuse me, I keep doing that. Overbought territory. Red is overbought territory, but it's finding its way back to its average. So let's go run our put bot to see if we can catch this. All right, so I'm going to run it. Now we are bearish on SPY. We're going to hold it for 44 seconds. Target is 5%. Stop loss 18. Boom. Let's see if you found one, and you did. Let's go ahead and execute it. Beautiful. Now we're in the contract. So we bought, let's see what did we buy? ATM 675. So we bought near. We paid $148. Delta's 42%, so that's not bad. Theta's here, IV's there. All right, so that's not bad. So let's see. Market just turned. Market just turned on us like a mug. We're trying to go one way. Now the market just went that way. And that's what happens. I'm not going to guarantee everything, right? I mean, sometimes the market does go against us, right? We thought it was going to be one thing, but the market said, hold my beer. So in another few moments here, we're going to see what happened. All right, so this didn't turn out for us. We didn't catch that that bearish setup. The market did turn a bit, right? The bulls did catch back up. So that's what happens. So one of the things I definitely hope that you were able to get from this is understanding what a put contract is, how to be able to work and make a put contract work for you, and actually being able to trade one yourself. So if you do have any other questions, please let me know. It is your boy Kreative. I'll be back at it again with another episode.